your host, as always, Thaddeus Campbell. Excited to be joined tonight by someone not only do I consider a close friend and incredibly insightful into the world of self-storage, we also happen to have graduated from the same university, Tufts in Boston. Me a little bit ahead of him, sadly, but excited. We both carry the same chip on our shoulder. Tufts is about 5 miles away from Harvard and MIT. So we fight a little bit to prove that we were worthy of the great Boston colleges there. Frank Desalvo, Senior Director of Franklin Street Self-Storage Brokerage. Thank you so much for carving some time out to come and join me tonight.
Yeah, absolutely, Thaddeus. I appreciate you having me on here. It's a privilege to finally jump on the podcast and talk some storage with you.
I'm not going to tell them how many times I had to reach out to you and send a link to get you to sign up to do this with me and guilt trip you on LinkedIn.
I wasn't gonna let them know that either, but we can get an account to figure it all out.
Listen, I got a lot of stuff I want to go into you with, especially at this particular moment in the life cycle of self-storage. It's such an incredibly interesting time. Even people I talk to that have been in the industry, 50 years, since the early 70s, really a different time in the self-storage world. So I'm excited to dig into it and get some of the excellent perspective you have with as many different people as you talk to in your day-to-day. I always start when I talk to people because storage is such a niche thing. It's such a unique industry. I always like to kind of get the journey of how the heck does someone going from being a Tufts University jumbo to a broker in self-storage?
Yeah, that's a great question. Because I didn't major in self-storage at Tufts. I don't think they were offering that major then, and I don't think they're offering it now. I majored in sociology at Tufts. I graduated in 2011. I quickly found myself in New York City. I actually interned and then worked for a few record labels in the music business. I then transitioned into a hospitality role while I was in New York City with a growing restaurant chain that was backed by a family office based in Soho. Eventually, I started working directly for that family office, and that family office was primarily focused on investing in multifamily and then more recently self-storage in the Southeast. So I quickly found myself in an acquisitions analyst type role. I was meeting with owners direct. We were sourcing deals direct. We were networking with a lot of brokers. While I was there, we built up a portfolio of about 12 or 13 self-storage assets throughout the Southeast. We started with value-add acquisitions. We then switched to value-add acquisitions plus a development component. So we were buying your 30 or 40,000 square feet with 2 acres to expand. And then we were executing on the expansion there. We were raising money per deal or per 2 deals from friends and family. At the end of 2019, that partnership started to go more into multifamily, less interest in self-storage. And it was really more so for a reason that they had larger investors that wanted to write bigger checks than self-storage would allow on a one-off, two-off deals. So they went more in the multifamily development side. I still was very committed to self-storage. It was, I've been doing it for 3 years. And at that point, I decided to switch into the brokerage role. So I joined Stan's Investment Group in the beginning of 2020, helped build out their self-storage platform there. After a few years, switched over to Franklin Street in September 2022, which is where I find myself today and, what has essentially brought me here. I would like to think the culmination of it is now this podcast, right? Is kind of what I've been working towards.
The pinnacle of your journey of storage. I'm going to safely say that is not the case. Maybe the next 3 or 4 times we have you on, we'll get to the pinnacle. So many doors I could go through here. I guess the first one I'm going to go through is why self-storage stood out to you as something you'd want to stay in instead of going the route of kind of going with the company and concentrating in multifamily.
Yeah, that is a good question. I think at the time, one of the things that really appealed to me within the self-storage sector was sort of the time we were in and what was happening within the asset class. It was a very exciting time to be in self-storage. There was institutional money that was, starting to come in. There were a lot of private equity groups out of, New York and other large cities, Chicago, that had just sort of really discovered the asset class. The other thing that happened while I was just kind of getting started in self storage was the larger REITs started rolling out their third party management. So that was kind of a major game changer for a lot of people that maybe wanted to get in the asset class before, but didn't want to really understand the management side or really want to build a management company, which is, a ton of work. That had sort of excluded all of these people and kept them on the sidelines. And when Extra Space, CubeSmart, some of those REITs that started on the third party management chain early on, 2017, 2016, if I'm remembering correctly, that sort of opened the door for a lot of other major money to sort of walk through. And I thought, at that point, I didn't have a ton of exposure to multifamily, but the more people I talked to, it was like, hey, this asset class has already been here. Self storage is just on the brink of arriving. So that's really the biggest thing that drew me to self storage.
I'm interested because it's self storage is pretty unique in this sense that you have these what used to be five or six, now really four, between Public and Cube and Extra Space having bought Life Storage, and then NSA REIT, which is sort of a conglomeration of a bunch of different brand names. But you have a small group of companies that really manage, even though they don't own a vast majority of places, they manage a bunch of places. There's not really another real estate asset class that you can go buy where you can hire somebody at that expertise. And in reality, it's not a huge cost to have them come in and manage the facility for you.
Yeah, I think, and again, I'm not as familiar with some of the other, I think multifamily, there are some management companies out there and, that type of thing. I'm not as familiar, but I think that, that's something that has really changed in our space. And now when you go to, trade shows or anything like that, there's all sorts of new management companies popping up because there has historically been a void, right? That hasn't existed. And I think that's changing. I think that's radically changing what we, consider a self-storage owner operator. It used to be the mom and pop that sat at the facility for sometimes 6 days a week, and it was their retirement project. And you would talk to these owners, and this would be the second time they retired, and this was kind of a new venture for them. And they made a lot of money doing it, but they weren't scaling. Right, self-storage has now become a scalable asset, and it's thanks to a lot of these third-party management companies that's allowed that to happen, right? Allowed it to be a scalable asset.
I think that's interesting. We're Safe Storage USA, the company I work with. You're obviously very close with Russell and David. We're talking to a facility right now where they have a apartment in the facility, and that was very common, right? It was kind of a mom and pop, and even if it wasn't necessarily the owner, they had a manager living on site, right? So it's kind of
Yeah.
this funny thing where you go into the storage facility and there's like a 2 or 3 bedroom apartment built on top of the office. Not an uncommon thing in the asset class.
Yeah. Yeah. We see that, still sometimes. And it's not hugely popular anymore because as institutional money has come in, and that's the other side of it, right? They want institutional money wants clean acquisitions,
Yeah.
and storage is not it's not always clean, but they want to make it as clean as possible. They don't necessarily want people living on the facility
Right.
for additional liability reasons. So we've seen that go away. I mean, we still see, some groups, and every buyer's different nowadays. And in my opinion, we're starting to see, some of the regional buyers come back that really understand their markets. But yeah, we typically don't see a lot of people that want the manager to stay overnight or sleep
Have
at
to
the
deal with
facility.
that liability. I think it's so
Yeah.
fascinating. One of the things that the statistics that I heard when I got into self storage in 2021, so I'm really new. That really fascinated me was that rent per square foot in a storage facility is almost exactly the same as rent per square foot in a multifamily. Where, of course, in storage, you're a steel box, right? You got a concrete
Hmm.
floor and a steel box. There's no drywall, there's no carpet, there's no toilets. So I guess my point of why I'm saying this is if you're institutional money, why would you want to have an apartment that that costs money to upkeep, and you got to deal with a tenant that's got tenant laws protecting them, where you can take that space and turn it into storage and essentially make the same amount of money for the space.
Right. Yeah. I mean, you're basically offering a downside, right, that didn't exist in the asset class. And where we saw that, where we really saw that, and it became very apparent was during COVID when we had a lot of multifamily investors say, I'm trying to move from multifamily into self storage for these reasons. And it were the tenant, it was the tenant laws. And at the time, it was, self storage was a better buy. I still think it's a better buy, but there were all of these other things that came with a multifamily asset. And really, when you scale and you get to that next level, 100, 200 units, it becomes worth it. But if you're just talking about one apartment, that's the reason that a lot of people don't want it, right? Some people say the same thing about retail, right? Or car washes that are attached to self-storage facilities, cell towers, right? You see a number of these different asset classes that are sometimes attached. It's not a deal breaker for everybody. Some people will take it on if it's good income and it's sold at a good return, but there's a lot of groups that just say, hey, we don't want that. We need to spin that off. That's not what we do. We do self-storage. I think that's a great approach too, because when you just do self-storage, you become experts in self-storage and when you're doing a little bit of everything, you're a master of none. Right. So
100% jack of all, master of none, not what you want to be in, especially in this economy. I'm
right.
interested because you got into self storage like 2015, 16, 17, somewhere in
Mm-hmm.
that area. You've really seen three distinct iterations in what's essentially a short, less than 10 years, a short career in the space. You had that 16 through 20 kind of a lot of new facilities coming online, steady, still the slow growth, the 3 to 5% increase every year. Then you had 2020, 2021, most of 2022, where it was COVID crazy. I don't think there's any other way to really describe it. And now
Mm-hmm.
we're on this other side where there's some contraction going on. It's getting a little bit tougher. So I want to kind of pick your brain and kind of have you talk me through kind of those three distinct different aspects and what it's been like dealing with all three of them.
Yeah. I mean, again, I think that, for that time period, I can't speak to what storage was like before, 2016. But when I got in, it really did feel like it was still in its early stages of, maybe not existence, but like having major money come to the table. And most of the deals that we were going after, almost all of the deals we were going after were mom and pop owner operators. If we saw a REIT, because third party management was so new, it was just assumed that the REIT owned that asset. There wasn't this, oh, that's a CubeSmart managed or an extra space managed facility. It was the assumption that that was already owned. So we weren't going after any of those assets. Everything we were going after back then was really just a mom and pop managed facility. And most of the time we were getting the owner at the facility, or he just wasn't there that day, but it was an easy way to get, it was easy to get to the owner back then. I think the assumptions, what we used to underwrite to in the Southeast would be 3 to 4% rent growth year over year. We would have our expense load, but our expense load could be very different than the next person's expense load. So there was this really tough, trying to match expense loads back then was very difficult. A lot of times now people are like, oh, you underwrite to a 34 to 36 expense load. Like that's the way that it is. Back then, it was really tough to get owners to understand that you had a different expense load that you were bringing in with a management fee, with a marketing budget, with all these other things. That was kind of a losing argument. We didn't go down that route too often. Nowadays, everybody understands that, in my experience. So it was really tough because there wasn't that normalized expense load because everybody was managing things a little bit differently. But again, it was sort of a steady as she goes. There was a lot of excitement around the asset class. There was a lot of hype. There were a lot of people coming in with big money, and a lot of people started to feel like self-storage was actually reaching its peak. I mean, I remember there was a sentiment in my group and a few other groups that I would talk to that would say, hey, listen, it's gotten too hot. We can't do acquisitions. And that's why we switched from acquisitions to acquisitions plus development, to eventually just development, is acquisitions were too expensive.
Yeah.
Then COVID happens, and I think it created a little bit of an anomaly in the market, where you had extremely cheap capital and you only had like 2 or 3 places to safely put that capital. You had industrial, you had essential retail, and you had self storage. So that asset class of self storage started to get all sorts of attention that it had never seen before from some of the really big groups. And at the same time, the groups that were already there said, well, we still are here and we still want to spend this money at 3.5% debt, right? So that's really what drove, I think, self storage through the roof during that time period, drove valuations through the roof, and then also drove assumptions to, in my opinion, what we're probably, well, what we're now seeing were unrealistic levels in a lot of markets in the Southeast and throughout the country. A lot of people were underwriting the 10% year over year rent growth or 15% year over year rent growth because they had seen it over the previous 6 months or they'd seen it over the previous year. And that was happening, right? That was occurring.
Yeah.
But I think the mistake there, was that people assumed it was going to continue to happen based on, the state of the market, based on the growth in those markets. And then, we had this retraction essentially. And I don't think, the other tough part here is, anybody can point the finger and say, oh, well, that was a crazy assumption or whatever. But I also don't think anybody ever really could plan for interest rates to go up as quickly as they did to the extent that they went up. And that really has hit the asset class pretty hard in terms of valuations, but also hit the asset class in terms of people moving, which has now affected occupancy, which has now affected rent growth. Couple that with, a lot of REITs now bottoming out on their rates, driving for occupancy. And we now have what is now I've never seen in the asset class. And we ask most people, they're underwriting 0% rent growth year one, and then maybe they're going back up to 3%, 4% year 2 through 5 or year 2 through 7. So I think, again, to sort of recap, when I was in the asset class from 2016 to 2020, we were raising on a 7-year hold, right? That's what our IRRs were based on, and that's what we were presenting to our investors. 2021 through 2022 or 2020 through 2022, all of a sudden you had these ridiculous IRRs because people were flipping properties on 2-year holds and making, they were doubling up. And now we're going back to what, in my opinion, is a 7-year hold period again. The challenge with this time around is some of these acquisitions or some of these deals, you're barely going to cover debt service through the first year or two, and then you're going to start making money. So I think, that's something I've talked with a lot of clients recently is this isn't a 2-year flip. This isn't a 3-year flip. That's not really what real estate is to begin with, right? I think a lot of people just got it spoiled, but it's everybody got spoiled, right? So it's kind of resetting expectations and understanding where real rent growth is, where real valuation should be. And, I think it's also making everybody in the asset class that is going to stay in the asset class get a lot sharper in what they do. We were spoiled. Everybody was spoiled back then. If you're in acquisitions, you were buying a deal that may have not been the best deal. And if you were flipping at the right time, you were making a ton of money and looking like a genius. If you were a broker, your underwriting didn't need to be particularly tight because somebody was going to buy it anyways because they were getting such cheap capital. That's not the case anymore. It's made everybody get much, much smarter and resourceful. And I think long term, it'll be a good thing for the asset class.
I managed to make it through that segment of you without committing Harry Carey over here as somebody who's trying to do ground up development. So, you just said it's painful right now
Yeah.
with you're underwriting to very low rent growth. The rates that you're seeing, right? What the REITs are putting out as far as web rates and even street rates are not a indication in any way, shape, or form of what their actual realized rates are. So that side of it's been challenging. You said something else that really struck me, and I had Mitch Feldman on the podcast a month, 2 months ago, and he said something
Mm-hmm.
that I loved, which is that real estate is a get rich slow scheme, right?
Yeah.
You'll get rich. You buy the right investments, you do it correctly, and you'll make money. But man, was there some people that got really spoiled in 2020, 2021, 2022. And quite frankly, Russell talks about this all the time. I'm sure you guys have had this conversation. He timed it very, very well. They bought 6 facilities
Mhm.
in 19, 20, 21. We're able to flip 4 of them within 2 years of ownership. And as you said, in some cases, double or even more their initial investment. Man, it gets hard when you see that kind of success to turn around and go back to the
Yeah.
slow grind.
Yeah. And I think that's you talk with a lot of groups and they're having some trouble raising money right now. And I think that's what's happened within the investor pool is a lot of people have gotten spoiled. And they said, well, we got these 40% IRRs on 2-year returns. It's the same thing with sellers, right? When you talk about buying a property, well, we thought we could get a 5 cap. Now your property's worth a 7 cap. Well, it's just too big of a gap to bridge right now.
Yeah.
I mean, there needs to be market acceptance. There needs to be sort of an understanding where we are, and I think we're finally getting there, but it's taken a long period of time for sellers to understand. Hey, my property's not going to sell at a pro forma 5 cap anymore, a pro forma 6 cap.
I'm
It's got to be an
interested.
in place 7.
Sorry to interrupt, but I'm interested
No,
to
no,
pick your brain on this because you talk to so many sellers. This is just purely my opinion, not from any data that I have, but it would seem like the people that were really anywhere close to needing to sell sold in 2021, 2022. Because why wouldn't you if you're going to sell your facility that maybe would have been worth a 6 or a 7 cap and it was selling for a 4 cap because that institutional money was getting debt at 3.5%. They could afford to buy at a 4 cap because their debt was still less than their cost of owning the facility, right? The NOI
mhm.
was covering it. I'm interested to know if you're feeling like we're getting to that place again where there's going to be a group of sellers that need to sell that kind of make up for the fact that maybe there was more stuff that got sold during that period of like, man, how could you not sell your asset when you're peaking it? Are we getting to that place where maybe we're going to start to see some sellers come online where they are a little more realistic with their expectation of what they're going to get? They're not still dreaming of 2022 numbers, early 2023 numbers.
Yeah, well, first of all, I wish people listened to us back then because a lot of people, when we were telling them to sell in 2021, 2022, they said, well, it's just going to keep getting better and better because I'm in Charleston or I'm in Charlotte or I'm in Nashville or whatever it might be. And it's just going to the market's going to keep growing.
Yeah.
Obviously, that hasn't been the case. But to your question, I'm expecting one of two things to happen over the next 6 months. A lot of people have been betting on this leasing season to get people back to where they need to be to either cover debt or to realize their investment. Um, so far, based on the people I've talked to, it's been a mixed bag. Some people have seen really positive trends, some people have not. It doesn't sound like we're going to see an interest rate decrease, probably until the end of the year, if at all. So if we don't see a real positive trend during leasing season, I think there's going to be a lot of sellers that start to panic sell because they don't want to hold on to the investment for another year. If we do see a positive increase through leasing season, I think there's still going to be a lot of sellers that want to now sell based on the improved performance of the property. So I think what I'm expecting is Q3 and Q4 for us to see a lot more inventory on the market. There's a ton of inventory on the market right now, just not a lot of it makes sense. If you ask most buyers, they say it's all overpriced.
Yeah.
Q3, Q4, I think we'll see more inventory that makes sense, either because sellers have gotten really desperate and they're, okay to sell at a much lower valuation, or they've significantly improved the performance of their property and they're now selling at that realized value. It's weird. Most of the time that I've been in self storage, a stabilized property was above 85 to 87%
Yeah.
physical occupancy. And then during COVID, it was like, well, why is it only at 94%, right? Why is it only at 95%?
uh,
I'm seeing more properties now more than ever that are in like the low 80s, high 70s that have been around for 20 plus years. There's no reason they should be there, but it's just kind of a sign of the times where you're seeing decreased occupancy. So I think a lot of people are counting on this summer to be back over 85%, 87%. In the buyer's eyes, I can now go sell that story and say, hey, we have a positive lease up trend here. That was a dip, right? Not a true, you know,
yeah.
assessment of the actual property's performance. So I think we are going to see transaction volume open up in Q3, Q4. I think we've already seen a little bit of that, but I think it's going to open up more. It's just going to be a matter of for what reason, right? If it's a good lease up season, I think we'll see deals that make more sense to buyers because they can buy into the story and it's a better cap rate. And if it's a bad lease up season, then I think we're going to see some panic selling and we're going to see some lower valuations, but some really good basis opportunities if you can wrap your head around buying in a bad market.
Which, for us as people that did kind of time things well and are sitting here looking to buy something, but not going to panic buy, right?
Right.
That's music to our ears, because you need to either have something that makes sense or you need to have something that's being sold at a price where you just can't help but try and take advantage of it. So I wanted to
Yeah.
ask you a question. You kind of you timed your entry into the brokerage market pretty well, right? Like 2020, 21, 22, between starting at Sands and then going to Franklin Street. It was a good few years there of
Mm-hmm.
really not only high transaction volume, but really high numbers for what things were trading for. I'm interested to know, how does Frank Desalvo now in 2024 going into 2025, where, like you said, there's no guarantee that things are going to open up. What keeps you positive? What keeps you doing the work? What keeps you keeping the relationships open to continue seeing success in your brokerage?
Yeah, I mean it's interesting. I was joking with Dave Perleschi earlier, who you know well, is my business partner, and I told him I was going on this podcast to talk about our experience in brokerage, and we're laughing because we really haven't had a normal year of brokerage since we started, right? So like when I started in 2020, the entire CMBS, the debt market shut down. So I'm calling everybody in April 2020, and they're like, "Why are you calling me?" The whole debt market shut down. There's nothing happening right now. We can't do anything.
Yeah.
And then July, August, it starts to open back up. And that's why you kind of stay on the phone the entire time. And I tell that story to really kind of drive that point home is we don't know what's going to happen over the next 6 months, right? You mentioned we don't want to be panic buying. We're waiting for those really good deals. Well, if you're not continuing to network with brokers, you're not continuing to put in offers, you really won't know what a good deal is when it comes across your desk because you don't have anything to equate it to.
Yeah.
Is it going to be a good deal compared to where it was in 2021? Probably not. But could it be a good deal compared to what everybody else is seeing over the past 2 years? It might be, right? But you need to be really in the trenches to do that. Our job, as brokers, I think acquisitions, before when I was in acquisitions, and you're probably doing a lot of the same thing, you're cold calling, you're networking, you're underwriting, you're constantly failing. I'm a big proponent in Stoic philosophy. I don't think I could do this job without kind of reading a lot of Stoic philosophy every week. And that's really, you focus on your controllables and everything you can't control. You really don't exhaust a lot of mental energy on. So that's one of the biggest hacks I've been able to sort of access in brokerage and just in real estate in general, right? There's nothing we can do about the market. We can complain about it, but like there's nothing we can actually do to affect the Fed or the interest rates or the real estate market. I can go down to the side of the road and spin a sign and try and get more people to rent my storage units, but it's probably not going to be a good use of my time, right? So the best thing we can do is kind of run with the market that we have. I think it is a fascinating time. We're still finding success in this market, but we're finding it in very different ways. We're doing a lot more kind of matchmaking between buyers and sellers right now. We're not running call for offers processes anymore. That was a decision we made in the beginning of the year as a brokerage group. We just weren't, we didn't see it working anymore for us. So we've tweaked our, process, and we'll continue to tweak our process as we grow and as we get bigger. But I think there's a lot of things that are very exciting about this market right now. And again, going back to what I was talking about earlier, it's an opportunity, right, for us to get a lot better at what we do. If it's easy, then we don't really have to get that good at what we do because the market will take care of itself and we'll make a lot of money that way. When it's hard, that forces us to get a little bit better. So that's the exciting part about this type of market.
Man, I try so hard to hold this to 30 minutes to honor my guest time and to honor the people listening, because I want it to be digestible. I have like 50,000 things that I wanted to talk to you about. Dave, you brought up David Perleshi. I wanted to talk about him. Some things with your work ethic, because I've watched you at work a few times when I've been around you, especially at trade shows and mastermind events. So there's so many things. I really hope you'll come back onto the podcast sometime soon, because there's a lot of roads I'd like to go down with you. I'm going to say thank you from the bottom of my heart. Your information is fantastic. So much insight. And I love the fact that, listen, he's not making this up, right? Frank is literally talking to all the buyers and all the sellers every day. And if you ever saw this guy in person, the phone is to his ear 100% of the time. So really appreciate you taking the time to come on and share that information with people. That's what this is all about. One of the things I love about storage is that it's populated by so many people like you, not only super intelligent, but also kind enough to give back to everyone else. So thank you so much for the time.
Thaddeus, I appreciate you having me. Thanks again. Next time you want me on, just one time, and I promise I'll
Listen,
I'll
you
jump back
guys,
on.
Franklin Street's website's going to be crawling. Frank's email address is going to be crawling down here on the screen. If you want to reach out to him, for certain, he's all over LinkedIn. You can connect to him that way really simply. You want some insight into what's going on with buyers and sellers, there's no better person to talk to. So, man, I'll continue to be your advocate, not just because we went to Tufts, but because I have so much respect for everything I've seen since I first met you in the industry, and look forward to talking to you again soon.
Thanks again, Thaddeus. I appreciate it.
Hey, if you got something out of this episode, please hit the like button, subscribe to the channel so you get updates on future podcasts. I will see you next week on